In this module, I want to begin our course not by looking so much at valuation, but beginning by looking at the whole nature of real estate, of property. And so we're going to begin by looking at property in general, and then we're going to go in to look at what that tells us about valuation. To do that, we're going to work through a series of PowerPoint slides. That's this presentation. You can also read the study guide, which follows pretty much the same material but in greater depth. And so you can either follow this presentation, or you can simply read the study guide, which is the more complete treatment.
All human activity involves property in some way or another. This makes it difficult for us to see the importance of property simply because it's all around us and we take it for granted. To give you an idea of the importance of real estate in the economy, we'll just look at a simple example of bringing something simple, say some food, to market. If we're looking at milk or meat, it starts life, of course, out on a farm. And the farm is probably one of the most evident examples of land use, because the farmer does need land to grow his crops upon or to graze his animals. Then the products from the farm are sent to usually some form of factory or processing plant in order to turn it into something which is more suitable for human consumption. So the wheat will be ground into flour and then baked into bread. Under the factory will be land, and the factory owner must pay for the land or rent it in order to have the place where his factory can sit. So this is a second type of land use. After the food has been processed, say into sausages or loaves of bread, often it will make its way to a warehouse for distribution out to consumer shops. This is a third type of land use, although generally we include it in the same general group of land uses as factories and processing plants. The last stage of the supply chain between the farm and the consumer is the shop. This is where consumers are able to buy at their convenience things that have been manufactured from raw materials that have come from somewhere else. By the time we look at these four, we have four stages in what's called the supply chain, between the production of things on a farm or perhaps out of a mine or an oil well, all the way along to where they're in a convenient form and a convenient location for consumers to buy them. And what this means is that the consumer, in paying for the loaf of bread, is contributing a little bit to the rent of the shop or the value of its real estate, a little to the rent of the warehouse, or perhaps a little to the purchase price of the person who owns it, paying an amount for the rent of the factory property, and also some part of a payment to the farmer for using his farm, the land and improvements on the farm. These form at least three groups of property types. We have rural property, used for pastoral and agricultural purposes. We have industrial property, which is used for things like factories, production facilities, warehousing, and so on. And then we have retailing property, which is really just a fancy name for shops or shopping centres. Today, retailing property has become a specialised property type in itself, because that sector is now becoming dominated by large shopping centres. All along there as well, there are people. And people need land in order to live. Also, the consumers that buy the products from the shops also have to decide how much they're going to spend on buying their house or perhaps renting it, and whatever is left over out of their pay packet can go towards the things that they buy in their shops. And so to a certain extent, the retailing economy is partially dependent on the value and the cost of residential housing. And so the economic implications of house prices going up does eventually impact on retailing sales, and then it filters all the way back through the supply chain back to the farmer, and will have impacts on the land values under each of those. What this means is that to understand the land values, say for industrial land, one also has to have an understanding of the whole economy. And so there can be cases where if residential property goes up in value, maybe that will cause rural land values to go down, or at least not rise as fast. And these were concerns that were experienced, say, in the 19th century, especially in England, when there were arguments between the factory owners and the farmers, or the farming landholders, which were the old landed gentry, as to whether or not wages should go up. We'll get to that in another course. Suffice for now, we can see that there is these different groups of real estate property, and they all interact. As well as the groups that we've looked at so far, there is another property type which is now becoming quite dominant, especially as we move more from primary and secondary industries into tertiary industries. And that land use or property type is referred to as commercial property. We know commercial property largely as offices. In the past, offices tend to be built in the centre of towns, in what's often referred to as central business districts. Today, at least in the larger cities, there are being developed business parks, which are really decentralisation of commercial space, of office space, away from the CBDs, back into specific developments that are often a kind of fusion of industrial and commercial land uses. And so business parks are an interesting emerging property type. One of the things which is hiding in all of these is that all these property types all rely on land to some extent, some more evidently than others. Certainly if you're in the middle of a large shopping centre, it's not apparent that the shopping centre is using the land under it. Certainly not using it the same way that a miner or a farmer would be using it. But nevertheless, the value of the land under the shopping centre or under the office tower contributes in a very important way to the whole economics of the property as a whole. Likewise, there is an interrelationship or an interaction between land, which underlies all of human activities, and the rest of the economy. In other words, the activities, the labour activities of the people in the factories and on the farms or in the shops or in the offices. And these interactions become very important for understanding where the economy is going and also understanding where property values are going, which is really where we move into the interesting areas of property economics. Because land is so important, the ownership of land is highly desirable. In the Australian tradition, we talk about the Great Australian Dream. And this is largely derived from our background as a community which owes its origins largely to migration from the Great Britain and the other parts of the British Empire, but especially Great Britain. And this is because in the old part of the world, where land has been occupied for a long time, by the time we get to the end of the Industrial Revolution, relatively few people had access to owning their own properties. And as a result, the dream of being able to own your own property was something that was closely associated with independence and avoiding poverty. And so as Australia was developed, along with it came the promise in this wide open land of being able to eventually own your own property. And this has become known as the Great Australian Dream. Usually we apply the title specifically to owning your own home, a man being master of his own home, sort of master of his own castle, whatever. The Great Australian Dream. It's a lovely idea. Curiously, as you travel to other countries, you will find that there's also a great Singaporean dream and a great American dream. So depending on which country you travel to, especially in more recently developed countries, such as the United States, Singapore, other parts of Asia, there is this shared aspiration to owning your own property. In Australia, roughly 2/3 of the houses, the dwellings in Australia, are owned by their occupants. And so our home ownership ratio is fairly high. By contrast, in many parts of Europe, home ownership ratios are very low. It's far more common if you live in the Netherlands or various parts of Europe to live in rented accommodation all of your life and never to expect to own your own home, let alone a factory or a workshop or whatever. In Australia, however, property has become the major investment for most people. And this is because of this cultural attachment that we have to the independence. Curiously, in the United States, while owner occupation is on comparable levels, or at least used to be, the inclination is not so much to invest in property as an investment. Americans are more likely to invest in stocks and bonds. However, for the Australian, if you have some spare cash lying about, you're more likely to buy yourself an investment property, again because of our strong attachment to real estate as a symbol of wealth and a path to escape poverty. As a result of the popularity of real estate as widely distributed ownership, real estate is the primary security for most loans. If we look numerically over what banks have loaned their money for, we find that overwhelmingly, in Australia especially, bank loans are secured by real estate. This is actually similar to other countries such as the United States, where you occasionally find it explicitly recognised that their money isn't backed by gold, but is actually backed by the loans that, in a curious and complex way, create it. Suffice for our purposes, however, we can see that real estate is important in the economy because our entire financial system is largely, ultimately, linked to loans towards real estate, either for residential real estate or for commercial industrial real estate. We've already noticed that almost everything that we buy is some kind of a combination of land or a whole series of land components. We saw that in the case of the supply chain getting food to the consumer. If we take that a little step further, though, we can put in some other dimensions. As well as land going right back through the supply chain, the other major component is labour. And so the labour value, the wages earned by the farmer, by the factory worker, by the warehouse operator, whatever, and by the shop assistant, all contribute to the price of our loaf of bread. The third contributor to the price of our loaf of bread is the capital. And capital is, well, strictly speaking, the tools or the previous products which, instead of being consumed, say like the bread, is actually used in the act of production, such as tools. That could be hammers, chainsaws, computers, large bakery systems, production lines, and even the buildings themselves. So as we look closely at land, we notice that Land is the basis for real estate, but on the land is built the improvements which largely determine the land use, whether it's a house or an office block or a factory. And those improvements, those buildings and whatever's inside them, are in fact a form of actual capital. They are the result of labour being applied to raw materials in terms of the metal and timber or concrete and glass that the building is made from. The characteristic of capital, true capital, produced capital, is that it tends to depreciate over time. And so over time, a house or an office or a factory will tend to become less and less valuable as the roof gets rusty or the walls get to the point where they need painting or major repairs, or maybe the whole structure needs to be torn down and rebuilt. Capital tends to depreciate. That's actual capital. We use the expression capital rather loosely. We also, these days, tend to use the word capital to refer to money. Money tends to function like capital, but strictly speaking, capital refers to those physical, tangible things, buildings and tools especially. If we think of capital in this narrow sense as a physical previous product, it's relatively easy to see that capital ultimately is composed of land and labour alone. If we look at our factory building, for instance, we can see that the factory building might be made of steel and timber. Where does the steel come from, or the timber? Well, the timber was originally coming out of a sawmill. That's sitting on land. The timber was originally a tree, which was just in some forest somewhere, which is largely land. And of course, to get the timber or the tree cut down takes labour. To saw it up takes labour. And so we can start to see that the timber, at least, is largely a matter of labour and land, if you define land as anything that humans haven't actually produced. When we look at these three factors of production, land, labour and capital, then, what we find is that the capital component, so long as we're looking at strict capital, ultimately is simply land and labour. This means that almost everything we buy is really a combination of mainly land and labour. This will be useful to understand in the future, because what it tells us is that in the economy there is always a bit of a tension between the price of land and the price of labour. Because for our loaf of bread, if the price of land goes up but we're not able to afford to pay any more for our bread, then it means that the price of labour must go down. We can do that by either paying our labourers less, or by in some way using less of them, say by using smarter machines. And this tension between land and labour is something we're going to find coming back into our thinking from time to time. One example, which is very common today but relatively poorly understood, is the way that increasing residential house prices is really eroding the standard of living of the people using those houses. And so the standard of living of the occupants of houses, which is really the physical side of their wages, is going down because the value of the land they're occupying is going up. Again, we'll explore this later on. When we're looking at the Great Australian Dream, we often associate it with the expression real estate. It's the first encounter that most people come with real property is to go down to their local shopping centre or what have you, look in the window of a real estate agency and see some piece of property that they might be interested in buying. Usually a house in the first instance, but it could be a factory to run your business from, or maybe a farm to buy. To the extent that most people think of the whole property world as relating to the doings of real estate agencies. This is a little bit of a narrow focus, because really the real estate business is primarily there merely to sell other people's real estate. It doesn't really get involved in the economics and the utilisation of real estate. It merely is there as a shop front to help sell a particular commodity, which in this case is real estate. In Australia, this has led to the term real estate having some unfortunate connotations. And so in the property industry, we tend to refer to it more as real property rather than real estate. This again is an Australian habit. In the United States, real estate does not have the same connotations, and so the term tends to be used for the property industry. In Australia, though, we talk about property, the property industry, and property professionals, and that's largely what people are educated in when they do degree programs leading to careers in the property industry. It's also worth noting that the major professional association related to the industry is called the Australian Property Institute, again focusing on the notion of property rather than real estate. One of the really nice things about land is that, unlike other things that we might own, other assets, it tends to appreciate over time. In fact, it appreciates without us really having to do anything to it ourselves. Often you might talk to people who have owned especially houses for a long period of time, and they might be quite proud of the way that their house has grown in value over time, and they will tell you about how they've changed the carpet in their house or maybe renovated the bathroom. But it's actually not the renovations that have increased the value of their property, because the house next door has probably gone through the same kind of transformation in value or escalation in value without its owner necessarily doing anything at all. And that's because it's land which appreciates, regardless of what's happening to the improvements. And it appreciates as a result of the doings of the community in general, the market in general, more specifically. And these things are happening regardless of what the owner is doing. And so it's often said that land appreciates even while its owner sleeps, which is really quite delightful. Because in order to save money or become wealthy, most people think of having to work hard. But the property owner doesn't have to do anything at all actively. They just sit back and, with a well-placed investment in property, are able to become wealthier without any work at all. Hence the great attraction of real estate. The growth in the value of real estate over time is referred to as its capital growth. When we look at historical trends in capital growth, we find that real estate has tended to outperform most other things in the economy. On this graph, if you look closely, you can see that the price of houses in Australia has risen over the 40 years or so between 1970 and say 2010 considerably faster than the general price level indicated by the CPI, or the inflation index. You'll also notice that the price of houses has increased considerably faster than the level of wages indicated by the adult wage index. Even if we consider household incomes rather than individual wages, we see the same thing, that house prices have increased considerably faster than household incomes. We mentioned a little bit earlier that if house prices are increasing faster than household income, it means that the amount of money left to households to spend on other things, not to do with direct housing expenses, these must be falling, which necessarily means that either those other things are becoming cheaper, which to a certain extent has been the case over this period, or the standard of living of households is falling, which is an interesting question that I'll leave you to look at another time. There's one other trend that is not graphed on this chart, and that is a relationship between house prices and population. It's a little bit difficult to do on a national basis because the real changes in house prices tends to be concentrated in different ways in different localities. But overall, it's closely related to population growth. And it has been noticed by many commentators, many thinkers, that land prices are largely related to the size and change in the populations that surround where the land is. For instance, land on the coast in the southeastern corner of Queensland, where there is generally a fairly high concentration of population, is considerably more valuable than land facing the coast, maybe similarly picturesque with similar access to the ocean and ocean views, maybe 100 kilometres either to the north or the south. And you certainly see that, say, around the Sydney region, where the value of waterfront property, say on the north shore or eastern suburbs of Sydney, is astronomical compared to the value of the same physical amenity 100 or 200 kilometres either north or south, even when those alternate properties are parts of reasonably prosperous communities. The bigger the population, the bigger the land value. The more the population is increasing, the more land values are likely to grow over time. These are important general areas or general ideas that are important to understand. As along with population increase, there's also the importance of the economic vitality of an area. And so we might look at a city with a population of, let's say, 1 million people, and if it's in a first world growing location, it will have a particular land value. But if you have a similar size city, but made up of a community that has considerably limited economic potentials by comparison, say a developing country, say like Manila in the Philippines, you will find that the land values are considerably lower. And so as well as population, we also have economic vitality as important determinants of land values. Often we look at the other side, though, of the way that property prices or property values might go down over time. This is often as a result of the improvements becoming less valuable, and so we'll be talking about obsolescence. And in the property world, we talk about physical, technological, and economic obsolescence as three ways of understanding the way that properties do lose their attractiveness. Physical obsolescence is simply the way that improvements, say a factory building, might wear out over time or might become decrepit. Technological obsolescence is where the special features within a building become less useful. So, for instance, very high ceilings have become less valuable. Buildings that are dependent on expensive fuels such as oil rather than electricity or gas become technologically obsolescent. Specialized factories likewise. The last form of obsolescence is economic obsolescence, and this is where the property has not become physically or technologically obsolescent, but it's still overtaken because of more general economic factors. For instance, a motel might be in top shape physically and technologically. However, if the location that it's in is bypassed by a major motorway or something, all of a sudden that motel will become far less valuable simply because the local economy has been devastated, because there's no longer the passing trade to come and use the motel. The behaviour of land values over time is often assumed to be one of singular increase, and real estate agents are especially fond of pointing out the way that land values only ever go up. However, it's important to know that land values in many cases also can go down. In many communities in Australia at present, or at least say over the last 20 to 40 years, land values have in fact fallen over those periods. The way of understanding that is to think of the ghost town, and we'll now look at an example of the ups and downs of an urban community. We're going to use the example of the town Jerome, which once was the fourth largest city in Arizona in the United States. This was back around 1920, when Jerome was a major mining centre with a population of about 10,000 people. However, once the ore started to run out, and also the economic changes that were happening in the late 20s and early 30s, the town of Jerome fell under hard times, to the extent that by 1953, the population had fallen by 90%, down to about 100 people. And so Jerome then really looked very much like a ghost town. It's not hard to imagine what property values would look like in 1953 if you owned a property in Jerome. Hardly a real estate agent's dream place to work. However, if you visit Jerome today, what you'll find is that the population has increased back up by about 400%. And that's because it is now a centre of art and tourism. And so the town is now looking solid again, even though with a smaller population. But by the time you add the visitors to Jerome, you find its population has grown even more than the 400% would indicate. And so Jerome is now a thriving little community. Perhaps not with the same property values it may have had in 1920 relative to wages. However, still coming back on. And what it does overall is illustrate the way that population rising and falling does have quite an influence on the fortunes of property. If nothing else, this should give us some wary concerns about the truth of the idea that property only increases in value. A second misunderstanding or question in property is the question of whether to rent or buy. Now, this question is most easily understood in connection with residential property, with houses and home units and so on, although it's one which is also of interest to business owners who may be thinking about buying or renting a factory or a shop or an office. To understand that question, we really have to go back to this very simple comparison of the two possibilities, especially when we said that different countries have different tendencies in terms of what people tend to do. When we look at renting, we find there are a number of advantages to renting. To rent is usually cheaper than to pay off a mortgage. It also involves little responsibility. It involves hardly any risk, because whether the property market goes up or down, or if a house burns down, who cares if you're renting? You just move on to another property. It also has the advantage that you don't need any amount of capital to rent a property. You don't need to invest all of your life savings in order to rent a place to live. In fact, you don't have to have any savings at all. And so that gives considerable flexibility. The downsides with renting are that there's no capital gain, and so in the long term, as rents tend to rise, you tend to have to rise, or the payments that you make in order to live in the house or the property, whatever, tend to rise as well. A third problem is that the tenant, the rental tenant, has little control. The landlord might tell you that you can't put hooks on the walls or keep a cat or all sorts of things, and the tenant merely has to comply. And also the tenant doesn't have a lot of control when it comes to stability. If the landlord decides that they want to sell the property or have somebody else come in as a tenant or whatever, they can simply tell you to move on once your lease is finished. Overall, there is a perception in Australia that paying money in rent is really no more than money down the drain. It is simply money which has gone with nothing really useful to show for it. This is probably a little bit cruel, because rent is payment for the use of what is a valuable asset. You might be using something which is worth hundreds of thousands of dollars, and so to be able to use something else, say if you might have a friend who owns a Ferrari that might be worth hundreds of thousands of dollars, and it wouldn't be unexceptional for your friend or someone who owns a Ferrari to charge you a fair bit of money to be able to drive around in the thing. And it's the same thing with renting property. You're actually paying for the experience of living in it. And so if it's money down the drain, well, that might be the case in the long term, but simply on a day-to-day basis, you're certainly getting some kind of value for it, especially if it's a nice property. By comparison, you can choose to buy property. The advantage of buying is that it gives you long-term independence. It means that you don't have to worry about where the property market comes or goes, certainly after you've paid the thing off. The purchaser of real estate has the advantage of being able to enjoy capital gain, and in the past this has been quite a major influence in people's thinking. When we go back to that graph we were looking at a couple of slides ago, we'd see that by owning property, you are able to own something that appreciated faster than anything else in the economy, which is certainly a lot easier than working in order to save, because somehow owning property means that you're saving automatically simply by watching your investment property from across the street or something. When you buy, you may not be buying with the intention of having it as an investment, but it does give you the flexibility to be able to move out and put a tenant in it if you want to. So you can turn your dream home into a rental investment as easy as you can phone up a removalist and actually move to a different town to live or whatever. And this is important. Often when people are considering residential property and are new to the property world, they will tend to think of houses as things that people own and that don't have any alternative uses or any rental potential. This is not really the case. And in fact, we find that all property tends to be valued ultimately on its rental potential, even if that's not realised. Another advantage of buying is that you're able to have maximum control over the property. There are some controls on the noise you make or what you build in your backyard, but overall you have about the maximum control of anyone in the community. You are able to rebuild that building, add to it, blow it up, maybe not blow it up, but remove it, demolish it, all because you own it, whereas the tenant isn't able to do that. The downsides of buying is that in Australia at present, typically to buy a property requires the use of debt, and so that means moving into what is usually a long-term relationship of obligation to a bank, and that does reduce one's flexibility quite considerably. It is also, for most people, when they first move in at least, a more expensive option than renting, This is because if you're borrowing, let's say, 90% of the value of a property, the cost of interest is usually considerably above the rental yield, the percentage of rent compared to value. And so the tenant has often got a lot more spending money in their pocket than the prudent home purchaser. Because of this, to buy property means that you need commitment, and this means you need a long-term plan. If you're inclined to be living in one place this month and a different place next month and maybe a different city the month after, buying real estate really won't suit you. There are a number of disadvantages with, or costs to do with, purchasing property that tend to make it an expensive thing to buy and sell, unlike, say, buying and selling motor cars. And so you need that stability. A third problem with owning your own house is that you've got to take responsibility for all the maintenance. If the house starts to leak on a rental property, you simply ring up the landlord or your property manager and get it fixed. If the house leaks and you own the property yourself, you either have to fix it yourself or pay for somebody else to fix it. And so maintenance can become an issue. And so generally, if you're looking at buying property, you have to have a good eye out to make sure that you understand what maintenance costs or possible maintenance costs you're likely to be coming across in the future. A final disadvantage with buying is the inflexibility of the purchase. To simply buy a property now and then decide later on to move across the street to, let's say, a equivalent house, maybe even an identical house in the same street, can often cost in the vicinity of $20,000 to $50,000 by the time you pay for all of the various legal fees, the agent's commissions, removalist costs, different tax obligations, stamp duty, and so on. And so the commitment to buy tends to sit you into one place fairly inflexibly. Overall, when we compare the attractions of renting versus buying, the overall value comparison reveals an interesting underlying relationship, and that is that real estate value equals the present value of the future rents. What this means is that as you go to buy a property, really what you're paying for is that whole series of rents off into the future. Later on and in other courses we're going to explore the implications of this, but suffice to say, the important thing here is that there is a connection between the cost of rent and the cost of buying, and it tends over the longer term at least to be relatively stable. It's expressed as what's referred to as the yield of the real estate, and yield is simply the ratio of the rent, the annual rent, divided by the value of the property, specifically the net annual rent. So that's the net income after you pay for the necessary expenses of owning the property. But this relationship is something that we want to introduce, or at least flag at the very outset, that rental values and prices are connected, and they tend to have this stable ratio, this stable level of yield over the longer term. The last point when we're considering renting versus buying is the question of what levels of rental exist in the society, in our community, and how those levels are changing over time. I mentioned earlier that there is about 2/3 of the dwellings in Australia are occupied by their owners. However, over the last decade or so, that level of home ownership, owner occupation, at least in the residential markets, is tending to fall. And the suggestion is that it will tend to fall further into the future, perhaps to the point where it will resemble some of the other countries where the dream of owning your own home are really quite remote. And so it's important, as we embark on understanding the way that property works, to be aware that the Great Australian Dream may be becoming a bit of an old-fashioned idea, because more and more Australians are always renting and are never likely to own their own homes. When it comes to the actual buying of real estate, it's important to get a bit of a feel for what the process is. Overall, the process of transferring the ownership of a piece of real estate from one person to another is known as a conveyance. And the cost of conveyancing is made up of a number of parts. When we look at buying real estate, the first port of call is to visit an estate agent, or a broker, as they're known in the United States. And they act as marketing agents or marketing fronts for the owners. The real estate agent will take a commission from the owner, from the seller, the vendor. And so this commission becomes a cost. The commission can run to a few % of the value of the property. The sellers also have a number of other conveyancing expenses. These include legal fees and, indirectly at least, fees associated with terminating their debt, their mortgage, and perhaps, to be totally complete, their costs of moving out, so removals expenses. On the other hand, the purchasers have a number of expenses as well. They're made primarily from legal fees, the cost of using a solicitor to organise the conveyance. Also included is stamp duty, which is a form of indirect tax, a tax which is paid to the government on the property value. So the more the property is worth, the more tax is paid to the government, and the type of tax is simply referred to as stamp duty. The purchaser, if they're using debt, will likely have loan establishment fees. These are often rolled into the principal of the loan, or taken out initially, so the borrower tends not to notice that they're being charged loan establishment fees, but they're snuck into the whole deal of the loan. As well as that, setting up a mortgage involves its own stamp duty, or indirect taxation, merely on the loan. And so the purchaser really has two lots of stamp duty, one for the property itself and one for the loan to pay. There can be legal expenses associated with the loan itself as well, although often the banks will tend to absorb these, although they will tend to express them as the loan establishment fees. And the last common, but perhaps optional, cost are removalist fees. By the time we add all of these fees together, we find that buying real estate, or at least transferring ownership, say to move, if your work causes you to move from one town to another, it adds up to being a fairly complex and time-consuming process, which can have costs, as I say, running into several tens of thousands of dollars. However, even with all of these costs and so on, and the relative attractions of renting versus buying, we still find that real estate maintains this overall attractiveness. And to summarise where that comes from, we can first of all fall back on the observation we made at the outset that land tends to appreciate in most cases without effort on the part of the owner. And this is certainly a great encouragement. In a good year, a family or a household is able to increase their wealth considerably more by watching their house value rise, even though they haven't done anything to it, than they would be able to through savings. Most Australian households, most Australian families, really have very low savings levels and very low savings potentials. What this means is that the average household isn't able to save money at all, hardly, at least in Australia in the last generation or so. However, Households that own property have seen their net wealth increase as the value of their house increases. This can be a little bit deceptive, because if you only own one piece of real estate, and that's the house you're living in, while the value of your house in, let's say, in Sydney in 1970 might have, let's say, been $30,000, whereas today the same property might be worth $800,000 or $600,000, 20 times increase. Realistically, the household still has to live somewhere. And so while you might be able to say, hey, isn't this wonderful? I now have wealth in the vicinity of $600,000, whereas before I only had $30,000. The downside is that if I was to try and sell up, you'd still need to go and find somewhere else to live. And this means that you have to spend your $600,000 to buy a house which 40 years ago would have only cost you $30,000. So it really tends not to put you in a net benefit. That apparent illusion, of course, lifts once you get a second house. Once you own a property which you don't live in, then land appreciation becomes very, very attractive. Over that period, 1970 to 2010, that nice neat 40-year period, we've seen capital growth in residential real estate running at about 9.75%, 9.75%. So even after we take off inflation of almost 6%, we find that we've got a nice, healthy, about 3, almost 4% of growth for nothing, really. And that's very, very attractive. And that's ignoring rental income, or at least the rental that you don't have to pay by owning your own real estate. And so if you do find yourself buying a property, you're going to have something which is going to make you wealthier over time, historically at the rate of about 3% per year overall, and you don't have to pay rent. 2 big wins. Some of the other attractions for real estate are that it's an easy to understand investment for amateur investors. Most people have a belief that they understand the real estate market, and they probably do to some limited extent because they've been able to see either the rents go up over time or occasionally walk past the real estate agent and look in at the values, and they certainly hear a lot about it from the newspapers and the television. And they then come away with the confidence they can understand this investment, whereas for many people, investing on the stock exchange is a bit scary and risky. As well as being easy to understand investment for amateur investors, and this is people merely investing so that they can find a place to live for themselves. It's also an effective investment for advanced investors, to the extent that you find that most larger investors invest at least some of their investment dollars in property. And the best example of this is superannuation funds. Even though they only invest a minority of their funds in property, they will always invest in some property. And of course that's ignoring the value of the land, which is within the shares that they're buying. Another advantage of real estate is that it's very easy to get debt finance. And by using debt to help purchase the property, you're able to magnify, to gear up, to leverage the overall performance of the investment. If you put in, let's say, 10% of the value of a property, and over a period of time, let's say 3 years, it doubles in price, you get to benefit from the doubling in price of the entire value of the property, even though you've only ever put in about 10% of its value, because your loan doesn't increase as the property value increases. And so the use of debt is a great incentive to buy real estate, and debt is extremely easy to get for real estate. As well as that, there are these periods where land values tend to increase quite rapidly. They're known as property booms. And these periodic booms create the impression that property is a magical way to wealth. And you'll certainly always hear the success stories in the same way that talking to fishermen, you'll always hear about the success stories, the big fish that they've caught, not necessarily all of the hours they've sat wasting away waiting for a single fish to bite. And it's the same with property. There are many losers in property, but the winners in property tend to be the more durable case studies and more durable examples, and over the longer term you tend to find that real estate does increase faster than everything else. As long as you're investing in property in a growing community, you can be confident of permanent and growing demand. The example of Jerome with the mining boom or the mining potential failing over time is worth being aware of course, but as long as your community is not dependent on a single income source, say from a mine or a particular manufacturing plant or something, and this is certainly the case in capital cities or major townships, you can look forward to permanent and growing demand, pretty much sitting on the back of the expectation of permanent and growing population growth. With all those attractions of real estate, and especially the complexity between real estate as something to own and live in, compared to something to own and use to earn an income, say in the investment situation where you're investing in order to have some tenant, it points towards the importance of understanding the business side of real estate, the business side of property. And this is where we move to looking at the various careers that are available in the property industry. The most common, and certainly the first and most important property profession, is property valuation. The property valuer is an independent professional whose work it is to give a reliable, in fact the most reliable estimate of the value of a real estate asset. Now this is really important because each block of land, each property, is essentially independent, because land is all fixed in supply. Even if you're looking at a street full of houses that might appear to be identical, there will never be any more, so they're fixed. And to a certain extent, even one side of the street to the other, there will be a certain amount of difference. One might be closer to the park, whereas the other one might be closer to a noisy road or something. And so being able to understand the impact of those things on value is very important. And while most people think they know the value of real estate, to get a reliable professional estimate of it requires a property valuer. And so there are many property people involved in little more than valuation. Ultimately, valuation is the core skill for just about all of the other property professions. We'll go through some of them. The next most common role in property is property management. And this is where you have people trained in caring for investment property, to look after the tenants, to make sure the property is kept in good repair, to understand the balance of what level of maintenance and capital expenditure will give the best rental results and therefore the best overall profit performance for the property. Property management is a very large employer, and it requires people who understand the property market, understand the physical assets of property, understand demand for rental accommodation, and to a certain extent understand where the community is going. So property management is an interesting and often very exciting and rewarding profession in itself. One step up from property management is asset management. Asset management is not the day-to-day workings of caring for tenants and maintenance and so on, but it's rather looking at usually larger properties as an asset in part of a portfolio on the balance sheet of an investment company. And so the asset manager, while they need to understand the general dynamics of the rental potential and overall requirements of running a property, their real focus is looking at complex properties, say office blocks or shopping complexes, as a single asset and making decisions about strategically when to buy them and sell them and how to manage them overall. Related to asset management is facility management, which is really halfway between property management and asset management. The facility manager is primarily interested in maintaining the quality of the facility, of the improvement. Facility managers are usually employed on larger and more complex buildings, whereas property managers will often find themselves in any of the wide range, right down to cottages. Before we get the property available for use as an investment, it has to be built in the first place. And this is the area of property development. Property development is a specialised area in property. Unlike property management and facility management or asset management, the property manager is looking for a far faster return. Property development, depending on what kind of development you're doing, can range from anywhere from about 6 months to 2 or 3 years for a particular development. So it's a very short-term property business. It's also considered to be considerably riskier, and because of the elevated risk, it also attracts far higher rates of return, far higher profit levels. And so the property developer is in a far more dynamic role, expecting to make high profits in a relatively short term, whereas the asset manager is likely to be looking at long-term asset strategies, not dealing so much with building properties, but simply having them occupied profitably. And the value of the land, which is within the shares that they're buying. Another advantage of real estate is that it's very easy to get debt finance. And by using debt to help purchase the property, you're able to magnify, to gear up, to leverage the overall performance of the investment. If you put in, let's say, 10% of the value of a property, and over a period of time, let's say 3 years, it doubles in price, you get to benefit from the doubling in price of the entire value of the property, even though you've only ever put in about 10% of its value, because your loan doesn't increase as the property value increases. And so the use of debt is a great incentive to buy real estate, and debt is extremely easy to get for real estate. As well as that, there are these periods where land values tend to increase quite rapidly. They're known as property booms. And these periodic booms create the impression that property is a magical way to wealth. And you'll certainly always hear the success stories in the same way that talking to fishermen, you always hear about the success stories, the big fish that they've caught, not necessarily all of the hours they've sat wasting away waiting for a single fish to bite. And it's the same with property. There are many losers in property, but the winners in property tend to be the more durable case studies and more durable examples, and over the longer term you tend to find that real estate does increase faster than everything else. As long as you're investing in property in a growing community, you can be confident of permanent and growing demand. An example of Jerome with the mining boom or the mining potential failing over time is worth being aware of course, but as long as your community is not dependent on a single income source, say from a mine or a particular manufacturing plant or something, and this is certainly the case in capital cities or major townships, you can look forward to permanent and growing demand, pretty much sitting on the back of the expectation of permanent and growing population growth. With all those attractions of real estate, and especially the complexity between real estate as something to own and live in, compared to something to own and use to earn an income, say in the investment situation where you're investing in order to have some tenant, it points towards the importance of understanding the business side of real estate, the business side of property. And this is where we move to looking at the various careers that are available in the property industry. The most common, and certainly the first and most important property profession, is property valuation. The property valuer is an independent professional whose work it is to give a reliable, in fact the most reliable estimate of the value of a real estate asset. Now this is really important because each block of land, each property, is essentially independent, because land is all fixed in supply. Even if you're looking at a street full of houses that might appear to be identical, there will never be any more, so they're fixed. And to a certain extent, even one side of the street to the other, there will be a certain amount of difference. One might be closer to the park, whereas the other one might be closer to a noisy road or something. And so being able to understand the impact of those things on value is very important. And while most people think they know the value of real estate, to get a reliable professional estimate of it requires a property valuer. And so there are many property people involved in little more than valuation. Ultimately, valuation is the core skill for just about all of the other property professions. We'll go through some of them. The next most common role in property is property management. And this is where you have people trained in caring for investment property, to look after the tenants, to make sure the property is kept in good repair, to understand the balance of what level of maintenance and capital expenditure will give the best rental results and therefore the best overall profit performance for the property. Property management is a very large employer, and it requires people who understand the property market, understand the physical assets of property, understand demand for rental accommodation, and to a certain extent understand where the community is going. So property management is an interesting and often very exciting and rewarding profession in itself. One step up from property management is asset management. Asset management is not the day-to-day workings of caring for tenants and maintenance and so on, but it's rather looking at usually larger properties as an asset in part of a portfolio on the balance sheet of an investment company. And so the asset manager, while they need to understand the general dynamics of the rental potential and overall requirements of running a property, their real focus is looking at complex properties, say office blocks or shopping complexes, as a single asset and making decisions about strategically when to buy them and sell them and how to manage them overall. Related to asset management is facility management, which is really halfway between property management and asset management. The facility manager is primarily interested in maintaining the quality of the facility, of the improvement. Facility managers are usually employed on larger and more complex buildings, whereas property managers will often find themselves in any of the wide range, right down to cottages. Before we get the property available for use as an investment, it has to be built in the first place. And this is the area of property development. Property development is a specialised area in property. Unlike property management and facility management or asset management, the property manager is looking for a far faster return. Property development, depending on what kind of development you're doing, can range from anywhere from about 6 months to 2 or 3 years for a particular development. So it's a very short-term property business. It's also considered to be considerably riskier, and because of the elevated risk, it also attracts far higher rates of return, far higher profit levels. And so the property developer is in a far more dynamic role, expecting to make high profits in a relatively short term, whereas the asset manager is likely to be looking at long-term asset strategies, not dealing so much with building properties, but simply having them occupied profitably. For most people, the only contact they have with the real estate industry is through real estate agents, or what is known in the United States as brokers. However, it's important to note that real estate agency doesn't have so much to do with the actual use of real estate and the employment of real estate as some profit-making component of a business strategy. It's merely the marketing and sales of real estate. And as such, it's really quite a different skill set to property economics properly understood. The real estate agents, of course, have a very good understanding of property markets, and so do property economists. However, their focus is far more on the sales and marketing of real estate, and it's only a secondary interest in its real investment potential. And you'll notice that if you speak closely to a real estate agent, they'll be very reluctant to make a firm commitment as to the investment potential of the real estate that they might have up for sale. This is not to say that real estate agency is not a very important part of the property landscape. It's absolutely pivotal in making sure that the market works efficiently. It's only to say that in terms of understanding the economics of property, brokerage or real estate agency does not need the same skills. The final career in real estate that should be taken into account is consultancy. And this is really property economics in its purest form. Property consultants are employed by both private and public bodies in order to investigate significant problems or questions in the whole area of the commercial utilisation of property, and to a certain extent the way that commercial utilisation impacts on society. Often town planners, both in private and public practice, will retain property economists to, say, investigate the economic implications of, say, planning initiatives, or to perhaps justify on economic grounds particular development proposals. For this reason, property consultants need to have a very strong understanding not simply of the property markets that they're working in, but also of the relationships between society and their use of property assets. Overall, what should be apparent is that there's quite a range of career possibilities in the real estate industry. From a distance, and certainly from the outside of the property world, they may not be so apparent. One of the great advantages of property studies is that while you're really doing a specialised business degree, and so the core skills are related to business studies, because you're working in a specialised field and you're developing specific understanding of particular markets and assets, it means that you're coming out of your degree with far more employable specialisation than a generic business degree. And so for this reason, we find that employment on graduation in the property area tends to be rather high. The other advantage is that the locations where property economists can practice tend to be far more varied. For instance, at present, while many property economists are employed in the major cities, there is also a very strong demand for property economists in regional areas, which very often suits the lifestyle and family aspirations of many people.